Psyched to have you. Thank you for joining.
Oh, happy to do it.
Have you decided not to shave until the crisis is over? Could be a while.
That's my plan. If I'm lucky, my beard could get as long as yours. We'll see how long this lasts.
I haven't trimmed my beard since January because I was trying to, I basically have the absurd idea that I save time on shaving by only trimming my beard every 6 weeks or something and just removing it entirely.
Yep.
But around February 15th, stuff started getting real weird. And it looks, what you have on your face doesn't look like it started growing February 15th.
No, this is only about three weeks worth since we shut down our office. It hasn't been that long.
Right.
But I feel like I got another month or two to go, so we'll see how it looks.
It could be a while. Yeah.
Yeah.
We may as well get started in a somewhat formal way. Thank you for joining.
Sure.
We should do some introductions. I'm Amol Sarva, and I run Knotel, which is a flexible workspace company. We operate around the world. We have several hundred properties between Europe and India and Japan and North America and South America. And it is my great pleasure to have you, Dave Bragg from Green Street Advisors. But you should tell us a little bit more about Green Street for those who aren't already subscribers to your research.
Amol, it's great to see you today. Thank you for having us. And Green Street Advisors is a real estate research and advisory firm that's focused on commercial real estate in the US and Europe. And we've traditionally been focused on the public market. We're known for our coverage of REITs. We cover more than 80 in the US and more than 40 in Europe. But over the last 5 to 7 years, we've pivoted pretty heavily towards the private market. And we ideally try to help out clients that are focused on either or both. And we believe that there are a lot of lessons that can be gleaned from the public market that assist private market investors in their investment decisions. And I'll be sharing some of those insights during this conversation today.
Okay, cool. Our topic is, nominally speaking, business as usual is over. What on earth is going on right now? And maybe we can just start with some big picture observations. Who are some of the names you guys track? How have they done? So the REITs, maybe the brokerages, or some other categories that you pay attention to over these last 6 weeks.
Sure. So we pay closest attention to the REITs, and we find that there is a lot of insight to be gleaned from the REIT activity nowadays, given the fact that the private market is effectively shut in terms of transactions. We're seeing some transactions that were in process a few weeks ago still across the finish line. Many more appear to have blown up and the deals fell apart. Therefore, while we're operating with very little clarity on where private market values are, the REIT market has sent a very strong signal. I'm just going to pull up a file here and tell you that since February 21st, when the REIT market peaked, around the same time that the S&P 500 peaked, REITs are down 34%. And that compares to a 24% decline for the S&P 500. What is helpful for private market investors is to take that 34% for REITs and adjust it for leverage, and you get to a figure that suggests that the performance of REITs indicates that real estate values on an unlevered basis have declined by 24%. But the conclusions are very different across property sectors. And before I get into those sector level details, I'd share with you that historically we have found that REIT performance is predictive of private market pricing. And directionally, this sends a pretty bearish signal for the outlook for private market pricing. That's not the only thing that we look at, though. We look at the corporate bond market, both unsecured investment grade and high yield. Both of those signals have been concerning of late, suggesting about a 15% or so decline in asset values for REITs. So we look at all three, REITs, investment grade, and high yield. And all three suggest that real estate values are definitely down, but it's impossible to be sure on the level on an absolute basis. And we do believe that during periods like this, at some point, we might have already reached it, or we might reach it in the months to come. The REIT market will overshoot, and there will be very attractive investment opportunities in REITs. Just to tell you a little bit about the sectors, at one end of the spectrum, if you own data centers or data center REITs, little has changed. The performance of data center REITs implies only a 3% decline in asset value. Similarly, self-storage, pretty resilient property sector during economic downturns, not really affected by our change in behavior amidst this pandemic. Asset values are implied to be down 12%. At the other end of the spectrum, the worst case sectors are healthcare, which is disproportionately focused on senior housing. There are a lot of mortality concerns there, unfortunately, as well as concerns over future use of senior housing. Malls, minus 35% as well, in terms of the implied change in asset value. Really, there's one mall REIT left nowadays, that's Simon. Lodging, down 35%. Understandably, this is a sector that's traditionally very sensitive to economic fluctuations because leases are one day long, but also the fact that hotels are generally completely unoccupied, and there's concern regarding the ramp back up that could occur hopefully soon. That sector has been punished. And then one more, office, down 25%. So kind of middle of the pack, in line with REITs as a whole. Office has been about an average performer, and the anecdotal evidence we've heard from our contacts on office is certainly that there's some discussion of forbearance and forgiveness in terms of rents, but it's not nearly as painful as the discussion that's occurring throughout the retail world.
Yeah, let's do them one by one if you don't mind. I think it's a really good map of what commercial real estate is, and start from the weakest. Senior housing or assisted living. I guess the thought is it may never come back. This could be like a game changer moment for the industry.
That's probably a thought on some investors' minds. The way I think about it is, if I remember off the top of my head correctly, that 10% of individuals who are over the age of 80 live in senior housing. And I wouldn't suggest that 10% is going to zero. I do believe that the U.S. has a greater share of senior housing adoption than other countries. Senior housing just doesn't exist, or exists in very small quantities in other countries. So I think that's always helpful to look around the world at how other countries live, and in other countries it's more likely to go back and live with one's children at that age. So I wouldn't say it's going to zero. Some may think that. I would more so suggest that 10% could decline to 9% or 8% at a time when tons of supply is on the way, because developers have been so excited about this big ramp in the growth rate of those above 80 years old over the next decade.
And a transformation perhaps in the operating cost of those facilities that do remain, right? I mean, they're just going to work differently and have greater liability and risk.
I agree.
The malls, is this the death knell? I mean, folks were teetering for ages. Do the malls ever come back?
I have a more bearish outlook in terms of the number of malls that we will ultimately need than our team does, but our team doesn't have an optimistic outlook either. We will see, yes, this accelerates the pain that many already saw on the horizon for the mall industry. It's a very good question as to whether or not we need any department stores going forward. Our base case, Green Street's base case, is that we need about 1 to 1.5 department stores per mall. That's down from the current level, but one could also make the argument that department stores are not needed whatsoever, that the opportunity to browse and gather information and compare products is much
Hmm.
easily done online anyway. And that if a mall does exist in the future, it would need a format more like a Bonobos, where you have a small amount of inventory that's really there for you to understand the product, and everything
Hmm.
else is not in the back, but it's in a warehouse, and it will get shipped to you the next day. So within the mall space, there has been a big shift lately towards restaurants, and restaurants are certainly temporarily negatively affected. We're probably over restauranted in the US. And I personally think that there will be an acceleration after this is all said and done of Uber Eats and DoorDash type systems for receiving food. Not suggesting that dining out will decline meaningfully. If anything, there'll be a temporary resurgence, a euphoria, I hope. When we get through this pandemic, people will be excited to get back out of the house. But some of the
Hmm.
areas that malls have been focused on in terms of alleviating their challenges in some sectors, those other sectors like restaurants are also challenged. So it's going to be
Hmm.
very ugly. It's slashed our expectations for malls. The public market suggests that values and growth rates are going down even more.
Hmm. When you characterize the sort of sweep of the future for retail and restaurants, and certainly malls, uh, it sounds like the future was on its way and it's going to come faster in some of the restructuring when you describe it that way. But maybe we can double click on the economic damage that happens between now and that future.
Mhm.
If Macy's furloughs 90%, if some of these big restaurant operators just don't reopen in 3 months when they're allowed to, because they just don't have the resources to even reopen at all. Um, that's damage to the structure, right? I mean,
Yeah. So I'd like to share a few thoughts on the big stimulus bill that was
mm,
signed into law on Friday. That
mhm,
applies here. The clearest and most positive takeaway is that the stimulus bill is very supportive of individuals who earn around the median income levels and who have lost their jobs amidst this pandemic. And we all know that there are so many of them. The 10 million claims, unemployment claims filed over the last 2 weeks are equivalent to the first 6.5 months of the global financial crisis, just to put that in perspective. Uh, for those earning around median income, uh, one will receive the one-time payments that we're well aware of
mhm,
$1,200 for adults, $500 for children. The timing on that is to be determined. They might come later than expected and later than they should. The unemployment enhanced benefits are meaningful. A worker earning around $40,000 a year would typically, it varies by state, but let's just take Texas, for example. A worker earning $40,000 a year in Texas who loses her job would earn about $400 a week in unemployment benefits. This CARES Act tacks on an extra $600 a week for the next 4 months. And all signals from policymakers thus far suggest that if 4 months is not a long enough period of time, it will be extended. So there are many households who very sadly have lost their jobs, but due to the CARES Act, they might actually earn more over the last 4 months than they did they could earn
nice.
more over the next 4 months than the prior 4 months. So that's a positive here.
Hmm.
Uh, there are some favorable implications for small business tenants, those with under 500 employees. There's an opportunity for forgivable loans that could be used for payroll or rent, and they're subject to a few restrictions. And then on the big business side, it's very unclear as to what this program could mean, but it could be huge because the Treasury is backstopping what the Fed will make into a multi-trillion-dollar lending program that could help out some of these big tenants that we're concerned about. Unfortunately, companies like Macy's, JCPenney have so many other challenges in the first place, it's just not clear at all to us that this will make a difference for them. But for some tenants who were otherwise in decent shape and are now facing a ton of near-term pain, these programs could prove to be very helpful.
To stabilize the raw damage with perhaps the smaller tenants, restaurants or retail.
Yes, the CARES Act, as we see it, was certainly primarily designed to help individuals and small businesses. But there's a lot of clarity that we still need to receive on large businesses, and we're open-minded that for some of these large businesses, which are key tenants for many sectors of the real estate world, it could be pretty helpful. We just have to wait and see what the Treasury says on this.
Let's continue our tour of sectors, because I, of course, am keen to get to office, but let's do hotels and lodging. This one, I wouldn't have guessed faces long-term headwinds. This is just a very deep and medium-term piece of damage. Is that how you would see it? Hotels are at like 1% occupancy at the moment all around.
I agree with your view on the near-term and intermediate concerns, but we are thinking through the long-term consequences of this experience. I think it has been well documented in the past that economic shocks, recessions do result in permanent changes in behavior. And right now we're all experiencing this sudden shift towards a virtual life. And that has potential long-term consequences. One obvious one could be online education and that impact on student housing. Student housing is very expensive, and everyone suddenly flipped the switch and was able to continue their education online. It doesn't mean that going to college and student housing will go away, but it could hinder that growth rate. Similarly, for lodging, I wonder about business travel. Even if there's a several percentage decline in business travel due to workers and executives realizing that not all of their business travel was essential. Much of it, probably most of it, will continue. But even if on the margin, each person does 5 or 10% fewer trips, that will have a negative impact on the lodging. I don't see any of that on the leisure travel side. If anything, over the near term, leisure travel will reaccelerate because we're tired of being in our homes. But the business travel side, I think, could be permanently impaired to some degree.
And businesses, something like 40% of lodging revenues, business travelers, or is it 60?
Well, my number is for the REITs, and it's skewed towards business travel, admittedly, but it's 75%. So the REITs don't tend to own resort leisure properties that might skew it down to a number closer to yours. But for the REITs, at least, that's a very big share that is exposed.
So let's do office. And before we do the office REITs, maybe we can talk a little bit about brokers and brokerages. I know you don't laser in on those stocks, but some of them are down 90% from 6 weeks ago.
Okay.
Some of the smaller firms and some of the bigger ones, they're at 30 plus minus. What do you think's the shape? I mean, because these guys, through the last couple of crises, 2001, 2008, they really changed as groups. The biggest brokerages are now actually big instead of a bunch of regional ones. And they started adding lots of relatively lower margin revenue from other stuff like facilities management and whatever. So that transactional flow is less critical to most of them. JLL bought a big finance company a few months back, and it's an important part of everyone's business. I wonder what you think the year looks like if you're one of these diversified brokerages in the US or Europe.
Sure, I have a few thoughts, and as you noted, it's not an area that we specialize in, so I'm not as well informed here, but a couple thoughts come to mind. First of all, leasing activity is near zero right now, not at zero, but it's severely depressed, and hopefully that begins to recover this summer, but that must be contemplated in the performance of these stocks. And then certainly transaction activity is near zero now, and that will continue for the next couple months and hopefully pick back up in a meaningful way in the second half of the year. I wonder about some of the adjustments that are being made by brokers in terms of virtual touring, and I wonder what that means over the long run in terms of decisions made by those that are leasing and those that are investing. But the figure that you suggested in terms of the sell-off in the stocks, which I actually haven't looked at closely myself, is more than I would have guessed. But you know, I'm not familiar with their balance sheets and how much that must be playing into it.
Yeah, I mean, those are certainly factors. Yeah, and the mix of different revenue. I mean, facilities management, you still need facilities management, and in a way, as we get to Office now and talk about Flex, my view in running Knotel of Office, both on transactional velocity and then on the Office category itself, we're typically less concerned about the sort of net asset value of buildings, but we are a driver of that, because what people pay to be in workplaces is fundamentally where the economic value comes from. We started this year with a certain view about how corporates are moving and changing the way they use Office. I think some of the assumptions that we had that we thought were getting well proven over the course of a few years, more flex instead of lease. Big cities have been winning for the long run and would continue winning. So corporates would be in the top 20 or 30 cities and keep on moving more and more people into those cities. Willingness to pay was in good times was quite high, because it actually saved money against doing it yourself. And we got to a spot by the beginning of the year that we thought, all right, well, co-working exists, but it's not relevant to Flex Office. And some things that happened last year that sort of clarified the separation there for us, and gave us a pretty clear swim lane. And we were thinking by January 15th or January 20th, we're a few $100 million in revenue. Probably it doubles this year. You know, we're in a dozen plus cities. We may add a few more. The share of Flex coming into the year was maybe 2 or 3% of all Office was Flex. We were thinking maybe another few points move, and that could almost double the whole category by the end of the year. But that does work off the presumption that people are doing things, that there is some transactional flow, that people are actually making decisions. And when faced with the decision, they go Flex versus lease or whatever. And at this moment, no one's doing anything. And this is a uniquely workplace-related crisis in a way. I mean, while travel and lodging is suffering a lot, that's not what people are going to remember about what happened over these months. What they're going to remember is no one went to the office for months. And that does probably mean there's some long-term change, but in the immediate term, my feeling is this is a very important time to see clearly why what we do is helpful to companies. We help all these companies shut down overnight all around the world. We're running operations in all these places, and then and now we're at the table with them. We're at the table with customers, because initially the safety crisis has now turned into a commercial one, and they're going to have to come to the table and figure out, like, some of them will be very distressed, and we're going to have to help them get through. And this is the conversation I think that a lot of asset managers are preparing for. You know, thankfully we do office, we do retail or restaurants or something, but some of our companies are going to need help, and we're going to have to help them get through. And on the other end, we have been discussing with every ownership that we deal with hundreds all around the world, that we need to collectively make sure that our cities and our economies and our communities of customers get through to the other end. And I've seen some of them start stamping out fairly standardized programs like blah, blah, blah abatements and things like that. And I wonder what you're seeing from the REITs. Have they yet explained what their posture is with the, I mean, on retail and restaurants, they have standard plans, I guess, they're offering. And are they yet doing it in office, to your knowledge?
I haven't heard much yet. There's, you know, a key topic of interest for us in recent weeks has been the thinning line between forbearance and forgiveness. And this applies to conversations between tenants and landlords. And it also, therefore, has to apply to conversations between landlords and their lenders. And a lot of that is getting sorted out as we speak. Our expectation is that compromise will be the first attempt. And if that doesn't work, unfortunately, litigation will follow. We've seen much more of this so far in retail and a little bit more in Europe than in the US, but I think all of it is instructive for the rest of the market, including office. So within retail, you've seen some landlords like the Irvine Company in California, or even Publix in Florida, which owns some of its shopping centers, have offered forgiveness. That's at the most extreme end of the spectrum. At the other end of the spectrum, you've seen
So,
some.
but what's forgiveness? So they'll say to one of their retail tenants, okay, 3 months, you don't have to pay.
Correct. Yeah. No payment of rent, not deferred, just it does not need to happen. That thus far has been rare, and I wouldn't expect a lot of it. The much more common path so far has been forbearance or a deferral of rent payment. I expect that to be where the compromise occurs. And at the other end of the spectrum, we've seen some landlords, I think Taubman, the mall company, is an example, that have said, you need to pay. And then you've seen some reactions from tenants, such as Cheesecake Factory, we've probably all read about, said, no, we won't pay, we can't pay. And so I think that those conversations are occurring throughout the real estate world, especially in retail, but they're occurring in office. And I'm hopeful that there will be opportunities for compromise that in the end will be mutually beneficial, because this is a very painful experience for everyone. And the more that landlords and tenants and borrowers and lenders can work together to share that pain, I think the better chance that leads to a better chance that next year, the beginning of next year, looks more like the beginning of this year did, just in terms of occupancy and.
Let's click through the retail flow again, just to continue to use it as an instructive example, because the future is already here. It's just unevenly distributed across the category, right? Retail has already seen waves of disaster. And in the case of retail, there isn't like a lender or an upstream monetary posture that has any opinion on this. You don't have like instructions to lenders that are, hey, lenders, you need to help retail as a category, as an essential industry get through this. I haven't heard of anything. Is that fair enough?
Yes, that's fair. And the only place where we've observed that is in multifamily, because the government has such a heavy hand. The government has said, Fannie Mae, Freddie Mac, we want you to work kindly with your borrowers. But other than that, I'm not aware of anything that has been mandated from the top down.
And so then when you're a lender, now let's go from government to the lender layer. The lenders in retail, I guess they'd lent something to Taubman or GGP or whoever. And as they start seeing workouts and rent rolls come back worse week on week, or if they hear from one of their malls that Forever 21 is not going to open on Monday, what has their typical reaction been? They have some kind of like allowance in their underwriting for 5%, 10% loss of rent roll, or?
So first, I think there's a debate over the borrowers and there's an effort to understand what it looks like in terms of the conversation between the landlord and the tenant, as well as with the insurance companies, and what the borrowers tenant business interruption insurance looks like. So the first step is, let's really understand everything available to the landlord, which is the borrower. And then the second step is to discuss the potential for forbearance and a deferral of that obligation. But I think that second step, how that plays out varies by the type of lender that we're talking about. So I mentioned Fannie Mae and Freddie Mac. The GSEs account for about 25% of originations in recent years. Another 25% would be the banks. And thus far, our understanding, this is just anecdotal, is that the banks are generally willing to play ball, and they're working with their borrowers. The same could be said for the life insurance companies, which account for about 10 to 15% of originations. Then you get to the messier areas where there's less certainty, and that would include CMBS, mortgage REITs, and debt funds. Those three groups have accounted in recent years for about 25% of originations. And that's where our understanding is that there's less flexibility, there's more red tape, especially on the CMBS side. The Fed is buying agency CMBS, and there's a huge movement afoot in the commercial real estate world to ask or beg the Fed to buy non-agency CMBS. I don't know how that will play out, but if that happens, that would be a nice reprieve for many involved.
Because the Fed would provide a floor on price, but they might also package restructurings of the terms in those loans.
I think so.
On a policy level, yeah.
Yeah.
Okay, so we're still in our retail example. I'm a mall operator, and I didn't lose Forever 21. Let's say I lost Macy's, my anchor department store, and I called my lender, and some of the lenders will say, all right, you're going to have to work this out. It's going to take you 3, 4, 5 months to maybe get a deal going, or a year or two. We might give you some forbearance on your debt service. Some of them may flip immediately. So if you're a CMBS or someone and you have defaults instantly, and now this owner's got a big problem, they're going to end up having the bondholders owning the property, I suppose. So that's what the owners are doing when they turn around to their lenders. But these owners, when they're facing that retailer, the retailer says, okay, I'm out. I'm Macy's. This location's closed. I guess there was some security, some deposits, some whatever. And then you pursue litigation immediately, or you go to the table and try to do a deal. Maybe Macy's pays you out. Like, what's the workflow?
First step would be to meet at the table and try to do a deal. And I don't have a strong opinion as to how successful that will be, but I do expect that to be the first step. I think that's the advice that lenders, borrowers, landlords, and tenants are receiving from their lawyers. Over the very near term, the courts are not necessarily available for situations like this. The courts, to my understanding, are more so available for emergencies. And so I don't know how quickly some of these disputes could even get resolved from a litigation perspective, which only incentivizes a heightened focus on compromise.
Yeah, the table, right? Because I suppose when a landlord is with Macy's or whoever trying to work out something, you haven't yet flipped an obligation to your lender. Once you fail to reach a deal, now you've got something that you need to go disclose.
I think that's a fair assessment, yes.
And at this moment anyway, I guess one of the judgments you might make, if I were Macy's, I have a fundamentally declining business, but my real estate cost is a major part of my operating costs. If I could come up with a new kind of deal with that landlord, maybe that location suddenly works. Maybe it's profitable. Maybe at the table we work something out, and instead of deep sixing your entire mall by having Macy's vacate, your mall can still operate. You give me a better deal, and as Macy's, at least I'm around for a certain amount of time. But the landlord judgment, I suppose, at that table is, okay, well, what's the deal I'm making here? Macy's is fundamentally declining. How many years am I buying out of these guys?
And so I think you're making an important point here, which is that it will be unevenly distributed, and there will be a prioritization of high quality locations and assets by tenants, by landlords, and by lenders. So the Macy's example that you just walked through applies broadly, and one resolution for one company could look very different from asset to asset. So I think that the weaker assets and weaker tenants will have a much tougher time, but even a weak tenant in a relatively strong asset has a better opportunity for a path forward.
So now let's translate this whole flow we went through to office, and I want to share my view at the moment. I think that we've got 3 phases of the situation to look forward to. look forward is maybe perhaps not the right term. It's going to be grim. I think the phase we're in right now is all bets are off. No one knows anything. It's April 1st, and rent collections, which companies are even alive right now, the layoffs. I don't think people have yet taken a view, as we have been observing across our customers, several hundred large companies, and as I've been watching the market generally of other private companies like myself with other peers, whether they run a health insurance company or a hospital or they run an e-commerce business. Knotel, in the space of a couple weeks, I think starting March 15th and by the end of March, we made some really big decisions to redesign the entire company. We took out a lot of the workforce and we repointed our workforce at a different thing, expecting a certain kind of whole new world order for the next 9 months. We did that. As I look at announcements that have been flowing out from other large companies, they haven't even started yet. Mm-hmm. I don't think anybody quite knows yet how bad it's going to be until they find out what other people are doing as well. And it is surprising to me, as grim as my outlook is, how broad it's going to be. I mean, you'd think health insurance companies were fine, and those guys are cutting a major percentage of their workforce. You'd think, a business that had hundreds of telemedicine doctors is fine. It turns out they're at 90% non-utilized, and at huge cost. It turns out it's just system-wide. And some of these folks, as they're starting to see some of these issues, when they make decisions about what they're not going to do next month, and they announce that, that's a lot of interaction between. So the phase we're in is no one knows anything. And the position that we've taken across our entire ecosystem with landlords, certainly, and with other members of the ecosystem like brokers is, guys, you're being way too optimistic. You think that this thing's over in a month, you're going to do a deal for 2 months, you're insane. We need a lot more cards to turn over before we find out if this is a multi-year downturn or not. That's our view of what's happening now. At some point soon, God willing, inshallah, we get to phase 2. Phase 2 is the economic consequences of very heavy contraction. That's when everyone has put their number out, reductions, cancels, all these things are changing. And that's going to be a double-digit minus GDP, and it might be Q2, it might be Q3, it might be more, it might be Q4. And a double-digit minus GDP, nobody's ever seen it. I don't think anyone's seen it. It's like whatever the $15 trillion U.S. economy is going to be a $12 trillion or $11 trillion next. It's just like, imagine looking out the window and 1 out of 7 buildings disappear. Like, that's what that means. It's going to be massive. I think there's going to be a lot of churn during that period, especially on office, companies recalibrating, moving, and transactional volume. But then there'll be a third phase. And for the moment, our view is that that would be starting in 2021 of like single-digit percentage growth, the kind of restoration of kind of normalcy, contracts being honored, not everything's getting retraded. People are starting to do business. And how steep that is and how fast that moves is a question. So I wonder how you see the world as you look forward in the macro way. What do you think about my phases, and what do you think about depth and duration on these?
I generally agree with how you laid that out. I think you made an important point early on that has become very clear this week. This is not a blue-collar recession only. I think that might have been a natural reaction 2 weeks ago when we heard about the layoffs in the hospitality space and the restaurant, the lodging spaces. The news of layoffs this week have been very, very broad. And therefore, this does have implications for office and for high quality apartments and many other areas. So that's certainly on our mind. And I think that the shape of the recovery will look very different depending on the property sector. The retail real estate world is quite worried about how it will look in the second half of this year, given challenges associated with inventory and with incremental changes in behavior due to even faster adoption of e-commerce and the health of tenants. But I'm hopeful that for some other sectors, perhaps including apartments, lodging, office, that the recovery could happen a bit quicker. And so I think that, yes, the second quarter will look extremely ugly. We're not economists. We actually haven't even updated our forecast for our companies and sectors because we just don't know what the economic outlook is. We'll do that in the month of May or even April. But right now, we're more so focused on things that matter a lot near term, such as tenant health and balance sheets of both tenants and landlords.
What are 2 or 3 things that you're really keen to find out next week? What are 3 numbers you're looking for?
Well, sure. A few things that we're looking for over the next week or so. Who paid rent this week, and in how much did that vary across geographies and across property sectors?
How will you
Nobody
know
knows.
that? Are REITs going to disclose it?
The REITs will disclose it when earnings season begins in the middle of April, but our analysts are having conversations with their private market contacts as we go. So I think that we won't have the complete picture, but if we have 10 or so conversations with apartment operators, 10 conversations with office operators, et cetera,
Yeah.
I think that we'll have a decent picture. That's what we're striving to do. I don't know where we'll come out. So who paid rent? That's one question. Also, what we haven't talked about yet that is worth everyone keeping a close eye on is what's the policy reaction at the state and city level to what's going on. We've already seen eviction moratoriums in New York and California. Where do we go from here on the policy response? That's on our mind. And then I would turn to the CARES Act, and we have open questions that remain regarding the small business program and the large business program, both of which should be answered within the next week or so. And then finally,
Oh my God. I mean, we'd be lucky to have those answered, Dave. I am very worried about execution here by the present government.
Yeah. So are we. It sounded great at first as we read into it, and we were skeptical about the ability for execution to occur as planned. And I think we're all hearing this week that those involved, including the banks, are concerned about their ability to execute. And then one piece of good news over the past couple of weeks, I'd say the past week or so, is that we have seen some improvements in the credit markets. The corporate borrowing market has improved almost, I could almost say dramatically in the last week or so in terms of the amount of issuance that we've seen from investment grade and now recently high yield companies. So we're encouraged there. We're hopeful for continued improvement. This is driven by the actions that the Fed has taken thus far. And one thing specific for real estate that we should all keep an eye on is what involvement might there be on behalf of the Fed in agency CMBS. It's just being discussed, it's being asked for. If that happens, that would be quite favorable for real estate.
Dave, it's been really enlightening to get your view on industry structure. I think I have so many colleagues and partners around the ecosystem that are going to watch this recording as well, in addition to the folks who joined. So thank you so much, and stay healthy, stay safe. Bye, everybody.